All right. Hi, everyone, and welcome to the TimingResearch.com crowd forecast news for January 26th, 2026. We are recording this at 4 p.m. Eastern Time, and this is episode number 512. So, my name is David Kosmeter. I'm the creator of TimingResearch.com, and today we have a special Option Professor solo market outlook episode. So he's going to be giving you his top ideas to watch right now. So I'm going to go ahead and turn it over to Jim, the option professor of optionprofessor.com.
Okay, thanks, David, and thanks everybody for being here. For those of you who are not familiar with myself, I'm Jim, the option professor. I've been doing options for decades upon decades, and I had a career of doing option seminars and option trading. So, again, I have quite a bit of product knowledge, and I certainly know how to explain options to people after all those years, right? Today, I'm going to be sharing my opinions and my views on the markets and things that I think there could be opportunities on. Again, you should always consult with your brokerage firm to determine your risk tolerance and your suitability for options. And also, again, we'll just be sharing opinions and ideas. We will not be giving out any advice. Okay, without further ado, let's get started. If you have any questions that you want to ask, you can put it into that chat box whenever you want to, and that'd be great. And now I'm going to start off by talking about what one of the questions was on the dollar and the yen. It's a big story, so let's take a look at it. First of all, I'm going to show you why it's even going on at all, which after you look at this chart, you'll get the idea why we are having such a to-do about the yen. I'll show you the weekly graph so it gives you even more perspective. Oh, maybe the 20-year graph might even be better. The yen peaked out in 2011, and it has been going in the toilet consistently ever since. So now we're down in this area, and I guess somebody over in Japan has figured out that maybe the yen has dropped far enough. That's their currency against the dollar. That's a pretty good slide. They have a new boss over there, and she wants to cut taxes. And she wants to cut that in an environment where they have a tremendously large amount of debt. And that has made people very concerned. And that's again while they're having some problem here. So there is some talk about intervention where, the powers that be will sell dollars and buy yen. And that has caused a very little pop on the yen. I'll give you an idea. In the last month, it looks like a lot, but you saw from the other graph, it's just a blip. But that's what they're talking about. That's a major pop in the yen. Whether it's going to hold or not, you got gaps here. Who knows if it's going to hold? But that has also done negative things for the dollar. And this is the dollar index, as you can see. Not looking so great on that either, right? That's a pretty big drop just in the last little bit of time. And the dollar index also has been kind of unwinding, and that looks like it might be breaking to the downside. I have been saying that if it can't hold this level down here, that it could accelerate to the downside. So this 96 area is my line in the sand. And where would it drop to? Well, I've got a yellow line up here coming in at about 90. So it wouldn't surprise me if it just made a beeline for 90 if they really sold dollars and bought yen in the size that some people are speculating they will. But again, that's the reason they're doing it because their currency has gone way down and also because they're doing tax cuts and they're trying to stabilize the currency. And again, I don't know for a fact, but it seems like the administration could care less about the dollar because their main concern is asset prices rising, the GDP rising, people out there spending, which is 70% of the GDP. And obviously, the capex keeps going with this AI story. So their priorities is not the US dollar. And again, the gold prices might be a reflection of some very bad feelings for the dollar and fiat currency, geopolitical, and maybe these central banks are just going to ease money and credit to keep this ball game going, and that's all good for asset prices. So that's the story right there, and that's the reasoning for it. But we have not hit the rip cord yet. We have not pulled the rip cord. The rip cord could be right there at 96. Again, there's nothing underneath here. That's never comforting. So keep an eye on it because it could be the bigger story as the year develops. With regards to other stuff that's going on, we had a couple of kind of investments into certain companies. The U.S. government decided to put some money into these guys. So you can see this thing has already been pointing up and continues to, it popped all the way up to 32. But again, it gave you a great buy signal down here. So if you did buy call options, and we had this on our list. So we did not mind it jumping up to 32 at all, because this is where we thought it was a good deal. Another deal that's going on now is with CoreWeave. And with CoreWeave, they're getting a deal going with NVIDIA. And the good news there is CoreWeave is popping out. And as you can see, it came out 190, came all the way down to 60. I told people this is the place, what we try to do at Options Alert is we try to look for options that are cheap that could grow dramatically. That means you have to be looking at things that have not moved yet. And so that's why this is on my radar when it made the turn here. And obviously, I thought it was going to pop. It's having some trouble here at purple, right? But if it can hold above purple, it could have more to go. In fact, it may go up and fill that gap near 130. So again, keep an eye on it here, because again, they do have the kind of news that could get it to continue to follow through. This has not been good news for a couple of other stocks that many of you are involved in. One is Advanced Micro Devices. Didn't like it too much because, again, it takes, I think, some business away from these guys. And of course, that's a high now surrounded by lower highs. So be careful that 270 might be a high point of significance, because that's a high point surrounded by lower high points. The other one that didn't like it too much was Intel, which already was under pressure from the other day, right? Yeah, I don't know why it went up there like that, because this company is still looking for customers, and the bottom line is now come back into some support zone. So monitor it here. This $42 neighborhood looks like there could be a lot of support. If it stops here, maybe it'll go back up and fill the gap. So keep an eye on Intel right here. It's at an interesting level. If they pull the trap door, you could go all the way down here to 34. So that's what's happening in the news on those two things are concerned. And then, of course, we got the potential shutdown on the government by the end of the week if this debate about Homeland Security funding accelerates, which it could after that very, very bad shooting of the nurse up there in Minnesota. There's emotions are running as they should, very, very hot. Anyway, that's another risk and things we got to talk about here. With regards to earnings, they are expected to be accelerating, and they're expecting to really do a great number here. So the bar is quite high. And again, this week we've got some of the big boys coming out here with Microsoft, Meta, and Tesla and Apple. And next week we'll close up with Amazon and Google, and then we shut down in February 25th with NVIDIA. So there's going to be a lot of information coming out here on the big guys here, and the big focus is going to be cloud growth. That cloud growth that Microsoft had with Azure, 40% last quarter, and Google 35%. That was music to the ears of the people who want to hear about some ROI with all this CapEx spend. With regards to CapEx spend, the more risk seems to be with companies like Meta and others, where they don't have that cloud exposure to bring in that revenue and bring in that ROI. Also, if the company's capital expenditure spend exceeds the operational cash flow, like it did with Oracle, people don't like that very much. And to show you how they don't like it, you'll notice that when Oracle was in that thing where their debt and stuff was exceeding their operational cash flow, the stock went from $360 all the way down here. So, that's a little bit of evidence that, they don't like that. And that company seemed to be firing on all cylinders. So that's the reasoning they give. So again, you have to be careful about the other guys. Amazon's probably in there pretty good, but some of these companies like Apple and Meta, may have problems, proving to investors that there is some inference, meaning actual use of all this stuff. So we'll have to see. There's a lot of growth expectations. So, if you happen to miss or your guidance isn't right there could be some very much punishment coming. So it's very important season we're coming in. Google has the Gemini right now that's being very well received. So they're in very good shape. Just to take a look at that stock. You can see from my work that this thing has been trailing my blue line like a little clockwork here. So every time it hits it, good place to buy, good place to buy. Just added another. So is it a good place to buy? We'll see. If it starts blowing out 340, that'll be a pretty good deal. In the aftermarket here, it looks like it's dropping $5 though. So you start getting underneath 320 on Google, that's definitely a warning sign, and it could mean that 340 might be as far as it's going to go temporarily. You blow out 340, you're talking new highs, and you're talking about you know a continuation of this very, very extended move. The other one in that area that I wanted to talk about is this communication sector is Disney. Disney's been in like a trading range here. Look, and straight, all these averages are converging. So it's going to do something. It's going to break out of that, I believe. And I think they have earnings coming up. I'll tell you when they have earnings coming up. They got them coming up on 2/2. So that'd be next week. So it'll be very important for Disney to come out with some good numbers. If they do, then maybe they could break out of there and really go on a nice little run. If they disappoint for whatever reason, you can see underneath 110 lies the abyss, maybe. So be careful on Disney because it does look like it might be making a major breakout. Look at the 5-year graph here. I mean, this is a congestion that will not last forever. You can't see it. This is going back 5 years. You see anything that congested before? Not too many times, right? So it's an unusual thing. Unusual things don't last. So that's why I'm expecting a significant volatile move one way or the other. Since this thing has come down and tested purple and held, that's a good sign, but it's having a heck of a time getting through gold. So that's why if it gets through gold, which comes in at about 115, I think that could be the accelerant that you're looking for. So 115 or better, maybe it's breaking out. Keep an eye on Disney because it's definitely wound up into into a little coil here. And it's a big company, and it's a company that a lot of people have exposure to, especially these ETFs, et cetera. So yeah, that's what we're looking for on the earnings. Supposed to be good growth, and the numbers are supposed to be good. Some people are talking about 15% growth in earnings. So like I say, the bar is quite high. The other thing they're going to be looking at is like, what is your actual strategy, Apple and Meta? How do you plan on actually making money with this? And Microsoft, Google, and Amazon, more execution of a strategy because they definitely have a strategy already in place, and it is bringing in some ROI. So there's going to be more about the execution, and Apple and Meta is going to be actually what's the plan, what's the strategy. Also, always watch those margin numbers they come out with. If your margins are shrinking, that's not good. So be careful that the margins are holding up because that's going to be, especially like on NVIDIA where it was like 79%, 80% is going to be kind of drifting a little lower than that. So that's basically some of the stuff that's going on with earnings. The risk to some of the application companies from Anthropic and OpenAI is very real. So these application companies include companies like Adobe. And if you don't think there's risk to these companies, you're not looking at the chart, right? Because this is the last 5 years, we've gone from 650 down to 300 here. And that's pretty much on the canvas right now. It had a little pop today, but that could be it could be a turn or a dead cat bounce, but it definitely has been under pressure. The other one is ServiceNow. So there's a reason why these things are going down, okay? And it happens to have to do with Anthropic and OpenAI. And you can see here, you gone from 240 to 130, and it's holding on for dear life right around here. So this is an interesting spot to look because the gold line is right there, which is an important reversion to the mean number. So again, this would be a place where you'd be monitoring to see if, in fact, it could have a throwback rally, because this would be up my alley in that the options are fairly cheaper than they've been. And of course, premium expansion can be very nice if it pops up to 160 or 170. And the last one I was going to talk about in this genre is Salesforce. And again, same story, under a lot of pressure, but it's hanging around this gold line a little bit. Obviously, being underneath it is not good, but sometimes it goes underneath it temporarily and then pops. Looking at your RSI, it comes in here at what number? 37. What's it come in over here? 40. You know what's key about that? The RSI, in my view, my opinion, as everything today is my opinion. If it can't get through 40 very well, I think you're looking at the lows. If it breaks through 40 and goes down into the 20s, you're going to accelerate to the downside. So I find this to be a very key area for Salesforce. And if it can hold down here and start getting back above 240, it could be an interesting market. Um, on the 1 year graph, again, do you have any divergence down here? 35 and 26. Yeah, that's a little weaker, but it's come back a little bit. Anyway, you can monitor it because it does fit the bill of being way out of favor and the options being rather cheap. So it's a candidate for a reversion rally. And if it does have one, those calls, which are relatively cheaper now, could expand dramatically. Um, okay. Yeah, let's talk real quick on the silver and gold, because parabolic moves like we're seeing now sometimes are accompanied with the end of a move, as opposed to the middle of it or something like that. So, but again, I think there's a legitimate reason that not many people are talking about, and I think it has to do with, I'll show you in a minute. On silver, I think it has to do with SLV. This is the ETF that is backed by physical silver. Okay, backed by physical silver. The other one is GLD. And GLD is physical gold. Now, the problem here is these people have been taking in billions, I say, of dollars. And they need to go out and buy physical gold and physical silver with the monies, because the GTF is supposed to be backing, I'm sorry, SLV, are supposed to be backing with physical silver and gold. Well, I don't know. I was in the gold and silver business a long time ago. I'm very familiar with it. I don't know that there's that much liquidity for them to go out and buy physical silver or physical gold. I mean, the central banks are hoarding it, and institutional people are now getting involved, and retail people. So I think this is a classic case of way too many dollars chasing too few available product. And so this is a squeeze, and I've seen a squeeze before with the Hunt brothers, but that was just a couple of guys trying to squeeze it, and all they had to do is change the rules at the exchange, and it came down like a ton of bricks. Here, I don't know what brings it down, but I would imagine two things could happen. And one would be that the funds themselves may say, we're not going to take in any new money because we have too much to handle right now. In other words, it's like when a fund manager maybe closes down to new investors because he has plenty of money to work with, and any more he might not be able to handle properly. That's not a impossible thing to happen, I don't think. And then, of course, the margin requirements are at like 50,000 or something like that, or something like that on the exchanges for silver futures. They could move that up to 75,000, and that could really put some water on it as well. So this is a good time to be careful with the metals, because as you know, most of the stocks have also gone up through the roof, and this will give you an instant on that, and so we're up at 120. I mean, the darn thing a year ago was going for $40, so three times in value. Also on GDX, and here you've gone from $40 up to 110. So these things have really taken off. And some people have asked about different methodologies of trying to manage the risk at this point. Obviously, I'll give you an example on something like First Majestic. Um, say you had the stock bought at $10 or something like that. Now it's up at almost 28. A couple of things. You got many choices. First one would be just sit tight and just keep holding it. Second thing would be to get out and grab your money. The third thing is if you had 10 or $12 calls is to exercise the call and take delivery of the stock and put it into your portfolio and leave it there. And another thing you could do would be to spread the market. Now, obviously, you've got a cost basis on your 10 and $12 calls. And so if you sold something in the 20 to 25 or 30 level, you'd bring in cash. And that cash would obviously hedge your risk of your original investment. And then you would have a look at a vertical call spread with hopefully enough money that you took in from selling the call to not only pay back your original capital, but give you a reasonable return as well if the markets were to collapse. And then, of course, rolling up the position, going from 10 or 12 up to 25 or 30 is another risk management technique that people would use. They all have their separate risks, they all have their separate purposes and costs. And then, of course, another thing would be is to turn it into a vertical call spread by rolling up the position and turning it into a vertical call, taking the rest of the money and put it in off the table. So this is not a terrible time to take the menu out and see what your choices are. I just blew through them at a pretty fast clip. If you want to speak to me directly at the end of the broadcast, I can explain how you can do that. You can always send an email to optionprofessor@gmail.com and let me know how to contact you, and we could discuss some of these different alternatives that are available. But anyway, I think risk management is very big right now. And I think, you can't step in front of a freight train. I don't have anything that really, I mean, this is an hourly graph. Give me a 30-minute graph. And even there, all it's doing is filling that gap and pulling back to the blue line. So, I mean, there's nothing tremendously negative today, even though it's gone down $3 almost because there is not, in a parabolic move, you're not going to have a whole lot of signals with any date, with any length of time on them to give you any hand with that. So again, sometimes you just have to manage the risk and realize, if I do nothing and it goes down, that's going to be a negative as far as the amount of money I get. Selling out and it keeps going up, that's going to be an opportunity risk that I might not want to have. So you got to find the strategy and the way you want to work it that makes the most sense for you. And that sometimes takes a little bit of homework to go through the numbers. So there's the gold and silver. And let's go over the stock market real quick and just go over what it looks like to me. Okay. So if you look at the 20-year graph on the S&P, you can see it's very, very extended. If you go to the 5-year graph, you can see it's stalled out. And if you go to the 1-year graph, you can see it's stalled out. So it's kind of hard to make a statement. I mean, if these earnings come in from the hyperscalers and their CapExes are still going crazy, you can break above 7,000 and take off, no doubt. And that's the way it looks like it wants to go. But if it starts taking out the blue line, which would be 68.85, which I think is about today's low almost, that'd be a negative. And it would open the door to come down to purple, and purple comes in at 6,700 ballpark. Okay. Now, the VIX. Excuse me. VIX. Okay, it's above 16. Let me show you the story on the VIX here. You can see it's had a couple of big pumps. Once in October, then right back down, which means scare and then back down and stocks rise. Here, you've got a spike and then back down, and stocks can go and back up. And just in November, spike, back down. Now the question is going to be, are we going to run out of here? And the answer to that is going to be in maybe one of the shorter term graphs. Because here's the deal. This was November, right? Then this is the big rally afterwards. And there was a big gap to be filled, and it just got filled, right? That's filling the gap. Large institutions and the like love a low VIX because lower volatility gives them great confidence to invest billions of dollars. When it gets above 20, sometimes that is when they lose confidence and that they will boycott buying stocks. And if they boycott buying stock, that is going to be, um, obviously a very negative for liquidity purposes. And therefore, you're going to have a big gap down in the stock market. Okay. So what we'd like to do is we'd like to figure out if that VIX is going to spike up. So let's take a look. Looks right now that it just filled the gap and that it's going to obviously make a decision. If you start hearing it above 17 and 18, I don't think that would be very good, particularly above this point here, 1750. So again, keep an eye on it. And if it starts getting above that number, that means you are going to open the door possibly of what? Going back up into this neighborhood. So I watch this very closely because again, a lot of the moving averages are under the price. See, if you get it under 15, then you're probably home free. Then we're probably above 7,000 on the S&P, and then we're probably going to get a nice big leg to the upside. Okay. Conversely, if it goes the other way, be ready. The other thing that has made me very constructive on the market is the percentage of stocks above their 200-day average. Now, come on. We had a big drop in the market in April, right? Well, look at the percentage of stocks above their 200-day average, tanking. Then we had the biggest run since then, 4,800 to 7,000. Look at that percentage rising, 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 rising. Then in November, a big drop and a test. You see, it tested the gold line, but it didn't stay under. And that was the test, 6,550 and 50 on the percentage of stocks. If you ever take out 50, if you ever take out 65.50, this market is in much more major trouble than anyone's talking about. So there's good lines in the sand there. So keep an eye on those numbers. And of course, this would probably correspond with the VIX jumping well above 20. That's the trifecta. VIX way above 20, this thing breaks under 50, and we take out 65.50. You want to be a bear? Then you'd have some evidence. Right now, you got no evidence. Okay, so this has been matriculating to the upside, and that makes me constructive on the stock market. That and the VIX staying under 20, right? Okay, and of course, holding 68.85 and that area as well is all constructive stuff. All right, so keep an eye on that. I think that's very helpful for you because being bullish or bearish at the end of the day, is a main part of how well you're going to do. Because if your opinion is bullish and it goes way up, a lot of things will go up, and that all what do you call it? A rising tide lifts all boats. Okay, the other thing I wanted to hit here before I get into some individual stocks that I'm looking at is Bitcoin, because I've been pretty good on Bitcoin because I follow this one chart and it seems to be pretty helpful to me. And it's the 5-year graph because I want this lines to be smooth, right? I want it to be smooth. That's the whole purpose of moving averages, right? To smooth out the volatility. Okay, well, this thing was going very nicely from 2023 when the stock market bottomed as well and turned up, right? And it's been going very, very nicely until October. Now, why would it stop in October, right? Why would it peak there? Well, those people who follow this stuff knows that there's halving every 4 years. And the history of halving is, and that happened 2012, 2016, 2020, and 2024. Now, on 2024, it was on April 2024, they did the halving. Historically, 12 to 18 months after the halving, the market peaks. It has a very nice advance after halving because of scarcity and other factors. And then it peaks. Well, guess what? April of 2024 plus 18 months is exactly what? October of 2025. Now, I think that puts the credibility meter to me way up. Now, what happens after the run-up goes and does its thing is a sharp decline of upwards to 80%, which would take your 127,000, 125,000. Well, let's just take a look at 125,000 ballpark figure, right? And take about 80% off of it. And let's get a number of 25 grand. So 25, 30 grand. Could it possibly drop that far? Well, you see these high points here? They come in at around 30 grand. So you see there, the high point is around 30 grand. So that's a place where if it wanted to collapse, maybe it would go down that far under certain circumstances. The RSI is certainly under 50. The red line's pointing down, blue's turning over, green's turning over, but you do have purple holding up at 80. And that's why I think 80 is a very important number. That's why I think it stopped there, right? This 80 area, right? So what do I think? I think right now it's consolidating. I think if it gets above 105 here, I think then you could come and put your party hats on and start talking about those crazy numbers, 150, 250, 1 million Bitcoin and all the rest of them, right? But if this thing can't get above 105, it can't go and make a new high. And if it can't make a new high, then that winter thing about going down 80% is still on the table. That's my call. As you can see, down 1,700 today. And like I say, if it does break under here and the RSI starts breaking down further, this is the 5-year graph. This is a weekly. So if the weekly starts collapsing, that's going to be some power. Now, it could stop at 70. It could just be a head fake. So I'll be watching that closely. Sometimes they break purple. They come down to this neighborhood here where the former highs are and hold, and then get right back above purple. Boy, would I be bullish then. If they ever bring it down to 70 and then they start trading it back above 80 and 90, boy, that would be really bullish too. So let the market tell you a little bit about what the future holds as opposed to, just trying to flip coins here. Because right now there's no evidence of it going through the roof, nor is there evidence of it collapsing. So maybe, let a few more cards come out before you put your money up. That might be not a bad idea. Okay, so there you go on the Bitcoin. And of course, the Ethereum, people like to look to this Bitmine immersion. But Tom Lee and his bullishness, he's a very sharp guy, but this has not been exactly going through the roof. And now he's involved with a guy named Mr. Beast. And I was not familiar with Mr. Beast because he's a little bit after me as far as generationally. But I guess he's quite the influencer. So I don't know if that's going to help or hurt because that's not my game. But I just wanted to mention he has something going with Mr. Beast. Okay, so that's enough with the Bitcoin stuff. And I think we covered all. Now let's just cover oil real quick, and then I'll get into some individual stuff. And then, of course, if you have any questions, don't forget to pop them in there. Oh, I got 3. So let me just finish up with oil, and then we'll get to some questions. CLH26. Okay, so what do you got here on crude? Let me show you why that 40 number was so important to me on crude. You see on the 20-year graph here, these lows here, can you see the RSI 39? And can you see the RSI 39, 42? Okay, that tells me that if they can't break those numbers around 55, well, first of all, if they do, thing could fall out of bed like you don't know. Look at that thing. The thing's all pointing down. You would think that it's going to really tank. But I'm noticing the RSI is getting stronger, not weaker. Let me tell you something else I'm noticing. And this is big news in my mind. Because nobody's talking about this, I don't think. This is the Goldman. Ooh, it's not. Hold on. This is the Goldman Sachs Commodity Index. And 50% of it is oil. And the other 50% is pretty much split between metals and agriculture. Okay? So I have been talking about this on the alert that you got to keep an eye on this thing because, as you notice, this is a 20-year graph going back to it goes back to 2015. It's a monthly. And that thing's breaking out to the upside as far as I can see. Now, I would love to see the green and the red line get above blue because, of course, when that happens, you can see that you can fly, right? So we are still early, but that looks like a periscope coming out of a submarine or something, right? So that is a very positive thing. That RSI doesn't look like it's kidding around. So if this thing's going to go up to, fill this gap, let me show you the gap. You see the gap right there? It's from 22. It's around 700, 700, and, what is that? Yeah, 710, 700. Well, that's a pretty big move from here. So if this thing's going to go up here, and this is 50% energy, energy prices may very well be going up quite a bit and very, very much surprise people. So I would keep an eye on this. And this thing here, these averages are a little bit more friendly looking to the upside, and the RSI is pretty well up there. Now, where is the RSI? It's at 62. Again, 60 is a big number too. In my world, one of two things happen when you get around here. This is either the top of the move and it's going to go right back into the soup, or it's going to go to 68 or 72 on the RSI, and it's probably going to jam up there and maybe go into 700 and fill that gap. So it's a very critical zone. The first critical part was $55 and the RSI at 39.40. Now the critical part is you've been able to get above gold, but the last time it got above gold, it failed. And if you notice, the RSI over here was 62 and the RSI over here is 62. So this is a neighborhood of very big significance for energy, for the index here, the commodity index. It has failed from this neighborhood before. It has failed at this RSI level before. But if it gets through this neighborhood, there's a lot of white area up here. And commodities are supposed to be a big deal. I just was listening to a guy from Morgan Stanley over in Asia. He's talking about expanding his commodity crew over there. So sometimes big companies know more than we do. So keep an eye on it. And of course, if that's going to happen, it could also be good for other products. I'll show you in a second. But getting back to energy, you can see that we're at a critical point. And I have been very friendly to energy because these stocks have done fantastic. People are telling me, "Oh, don't get into energy; it stinks. It's going to go way down." That's not the case here. Now, of course, it's extended here, but that doesn't mean being involved in it down here for that breakout was such a bad idea. And another one that's been on the alerts many times is Chevron, and Chevron also, going back to easier charts for you to watch. This thing had a very nice 2025, then it came back down, and then it turned back up in late December, and then it went up, and then it came back down, gave you another chance, and now it's back up again. So the bottom line is the energy stocks have been pretty good, particularly XLE, and particularly these two guys I just mentioned. Also, the guys who service these people. Schlumberger, nothing wrong with that thing. But again, they're extended now. They're extended. Again, these are not where you're going to get the cheapest options in the world because they've already had a move. Another guy in the servicing industry is called Halliburton. And of course, it's the same game as the other guy, 22 up to 35. That's very nice premium expansion in the last few months. So that's the story on the energy front. And I wanted to touch that. Well, we're piling up on the questions. Let's see what I can get here. Yes, available. Okay. All right, DBA versus DBC. I am going to take a shot at this one, Doug. Okay, well, this is the story on agriculture. Agriculture hadn't had its move, so it is undervalued as far as the other ones are concerned. In other words, they haven't gone through the roof yet, if they're going to go through it all. So obviously, you can see on a long-term basis, it did turn up in 2020. It just hasn't really accelerated. On the 5-year graph, again, it's pulled back here. You want it to hold the purple line, so you definitely don't want anything under $25, and it's at 25.76. And of course, it needs to get above 27 if you're ever going to make any real money. So those are your parameters. If you're the kind of guy who likes to buy the breakout or likes to go with the flow, you might want to wait until it gets above at least 26.5. And then, of course, if it can do that, maybe it can go up and fill this gap up at 28. DBC. And this is a general commodity fund. So obviously this one's doing better because this one will probably expose you to metals, which are going nuts, and it also expose you to oil, which is doing better. So nuts plus better plus okay equals this kind of chart. Now, where does it can go? Now, this one looks a little more interesting to me because that is just like, well, it's really just like the Goldman Sachs one. Looks like it's breaking out. And if it really is, there's a lot of room to go. So this one out of the two of them would be better from the standpoint of better momentum, better chart look. And obviously, again, the other one is the laggard. And laggard isn't going to look as good as when you put a little bit of STP in your gas, which is called gold and silver and copper, and then also have some energy in there. So this one out of the two of them looked like the better of the two as far as right now is concerned. That doesn't mean things like fertilizer companies, may not have a future. So this is CF Industries, and you can see on the 20-year graph, it looks like it's breaking out. And then, that looks okay. And that looks like it's already gone on a run. So maybe it'll pull back a little bit, but this is a company with fertilizer that could be interesting if you think the agricultural ones have a future. And then, of course, you've got commodities like soybeans. And again, soybeans, it looks, might have had a double low down here, 28 RSI and then 41. When you get a divergence like that, it's probably going to pop. But it has popped. It's already gone up $1.30, or excuse me, it's already gone up 30 cents fast. Does it have more of a future to it? Well, if it can get through purple here at $11, it could make a run to 13, particularly if it gets above 11.50. So, but it definitely needs, because look at the red line there. So it's a little dodgy still. But if you start above $11, that would be maybe the thing that stimulates a little bit more action on the upside. But yeah, so that's kind of what's going on in the commodity sector. We covered that pretty good. Covered the metals a little bit, and some of the stocks like Freeport-McMoRan, they've had some very good runs. This has been on the alerts as well. So we're kind of happy to see this thing perform a little bit. And then, of course, you've got Newmont's been on the group. And another one that's been on the alert is aluminum. But this one looks like it's stalled out. But this one had a pretty good run, as you can see here. 40 to 65 is very large premium expansion. Let's see what else we got here on the chat. Okay, we're good there. All right, so let's take a look here before we run out of time and give you some different stocks that that looked like they had some activity. Now, some of these I'm going to show you right now are just some that expired on the 16th of this month. And I'll show you, why they were on the alert, and you can see the volatility was tremendous. So this is Abercrombie and Fitch, and when it was down here, this is when it's going to fit the idea of buying a cheap, lower-priced option with some time on the clock and having some reason why it might go up. The reasoning I had on this one was as simple as this. These guys were coming out with clothes for kids, I was told, and marketing it through Macy's right before the holiday. I thought that would probably be a good, well-received thing. Secondly, they had earnings coming out. So I thought between the new product and Christmas and everything else, it was worthwhile to get a call option. And as you can see, between here and here, you had a tremendous move until January 16th. Right there is January 9th. So before the expiration date, you had a tremendous move in this thing. And this is what we're kind of out there scouting around for. Another one I showed you was the Alcoa, which we had like 3 weeks in a row that we thought it might have a big jump out of there. And then there's also companies like Dollar General who had a heck of a nice run because it was in a nice pattern here. As you can see, it was turning up. Well, and if you go on the 5-year graph, it was even better. You can see it was in this little pattern here of like what they call a wedge or whatever you call it. I call it a traffic jam that's gonna go someplace. And when the blue line is rising, the bet is that it's going to break to the upside. And obviously it did. It had a nice move from 100 and up to $150. That's kind of like what we're kind of looking for. Those ones that could, can spike out of there. So let's take a look at a couple of companies that might be able to do something like that. A couple of them we had on the list recently. One is called Arista Networks. And as you can see here from the 5-year graph, because that blue line was so good, I thought it would break to the upside. And so today it did just that. Now, whether it's going to follow through or not, maybe I thought it was going to fill this gap right here. So that's at 157, maybe, or 150, yeah, something 150 or better. Maybe we got another little bit on it, but I thought it was going to break out. But again, we'll have to see. But that was one that I thought would do that. And also Zoom was somewhat recently on the alerts. And again, it had a correction down to gold, which tells me that the correction may very well be over. And then, of course, it gets above purple. That's a positive. And it's got earnings coming out. And so, and obviously, we're on a Zoom call now, right? So the bottom line is that this thing is very, very popular still. And so that's why I thought it could have a pop, and it certainly did today. That's for sure. So that's what we're kind of looking for. Let's see if there's any right now that might fit that bill. One is called Marvel Technology. And you see it's in this little window here, but I like the 5-year graph right here with the blue line rising. So is this possible that it's going to have a nice move to the upside? Well, it's possible, and that's why it's interesting to me. So that gives you a little bit of an idea. But again, it's in a window here where it's going to break one way or the other, because I don't think it stays in this window forever. So we'll have to see exactly, but keeping an eye on that one, I don't think is a terrible idea. And Datadog is also one that was very much sold out that might be popping out of here, but it doesn't look fabulous. But again, you can see the reason behind it is that it hit the gold line, which told me that the selling may be over. And then, of course, I thought it might pop, and so it is popping a little bit. And under the right circumstances, it could have a significant amount more left in it to the upside. With regards to different sectors, I talked to you about Disney, and that's in the communication sector, and Google. Both of those are in a sector that could get some volatility to the upside, in my opinion. Then you've got some banks, right? Now, this bank here, because Trump was going to kill everybody who charges money on credit cards, got a big dump. But can you see it came right back down to some support here? And that support has been pretty good. So I would monitor this because this is, and they got a gap up there. So monitor this thing and see if in fact it's going to hold up. Use your own stuff if you'd like, but this is a thing that this is a stock that has gone on the defensive. Another one in the banking area is this guy here, which is your Citigroup, and again, it is trying to hold on to its blue line. If the news changes well for these banks, which people say it will, there still could be an opportunity there. And on the regionals, this one looked a little bit interesting to me. And this is a Western Alliance Bank, because you can see it's kind of following the line there. And then if you look at the 5-year graph, the weekly, if it does get going, there is some area for it to accelerate into. And I think these options are probably pretty dirt cheap. And then another one that I've liked for a while, stalled out, and maybe going back on the bicycle, is your Truist. So these are smaller banks, more from the Russell 2000 kind of people, right? And so this also has a lot of room to go if it wants to accelerate. So if you're interested in the banking stuff, I thought that those were kind of interesting. We got a big move in natural gas, and a lot of people sometimes look to this thing here, Boyle, and this thing is trying to make a move here as well. And then, of course, Williams and Company, WMB, is the more popular for big money, and that has made a move already of about, 10%. So it's already had a good size move. And if this thing ever breaks out, there could be a heck of a lot of opportunity here. And this is called Range Resources, but it's had a hard time breaking out for a long time. It's got a gap up there at 40. But if you look at the longer term graphs, if it really broke out, I mean, there is nothing holding it back if it ever really, and this is a big sideways action. So if they ever had a good reason to go, this is one I'd monitor. This is a natural gas type thing too. And, there's a lot of opportunity there if in fact it ever broke out, but it has been having a lot of difficulty getting above the 40-45 number. What else did I want to show you? Yeah, something. Some of these are big companies. Starbucks. On the longer term graph, is that trying to break out? Maybe, right? Maybe. And is there a lot of room above it? Could be. And I think it's got earnings next week. This one here got above gold, which is good, but as you can see, sometimes it gets above gold and it goes right back in the tank. So be careful at this number up here. You definitely don't want it breaking back under gold, which is 95 bucks. But if it starts breaking above the high there at 97, 98, you can see there's room for it to go. There seems to be a change at Starbucks when I go into the stores. So maybe that's translating into more profit and better margins. We'll have to see next week when they come out with their numbers. The travel thing was moving a little bit today. Booking was getting a move on, right? Let's show you here. And so I don't know if it's going to get back on the bicycle, but if it is, this one over here also looked like it was trying to get going. And you can see it's in a tight window, Airbnb. And of course, if it does break out, it could go on a decent run. The blue line's pointing up, which is a positive. So if we started seeing 135 and then started seeing 140, that thing could be one that could get a move on. So I'd keep an eye on Airbnb as the travel business may pick up, as everyone's freezing all around the country. They probably want to get out of town and go someplace. And then Amazon is going to be announcing next week. And it is, it come down here and it's held as 230 here pretty good. It's having a little trouble here, but if it has good news, it might be in a situation where you see how it's all tilting up. So could this thing spike up to 260 on some great earnings next week? It's certainly not impossible. So keep an eye on that because it's one of the more reasonably priced uh, hyperscalers because it's been kind of in a tight range. Same thing with Google. Google is in a situation here on the 1 year where, again, it's in a little tight window here. And with the right report, a spike up is not off the table. And so there you go on those two right there. Did want to talk to you, you saw Honeywell went nuts. And, there you go, 195 to 225. That's a pretty good move. And so I was looking at something else in the XLI that looked like it might be getting ready to pop out of there. And that would be this Union Pacific. Again, a traffic jam. Maybe it's going to take off. And on the 5 year here, you can see traffic jam here. So if you started seeing it trading at 230, 240, this is something in the industrial sector that could get going pretty good. So now here's another thing I wanted to bring up. They're supposed to be dropping the rates, right? And if they drop the rates, now let's take a look at how I've been watching this thing because I have not been deluded with the idea that rates have to come down. The reason I'm not deluded is I have a 20-year graph and it has helped me twice already. In 2024, he cut rates by 50 basis points, and everybody thought that the yields were going to go way down. And they did for like 1 day, and then boom, right back up again. This is the 10-year note. Then when we were crashing the markets last April, everyone thought rates were going to drop then, and it came down to the blue line, and then rates went back up. And then recently, we thought that the rates were going to have cuts and cuts and cuts, and now it's starting to move back up. So if we get under 4% on the 10-year, I'm going to be thinking we could go down to 3%. And if he brings a new chair in on the Fed, that might happen. So if we break down, some of the mortgage guys could make out very, very well. Two mortgage guys would be who? RKT, because there'd be a lot of refi and a lot of action, right? So this is RKT, which you can see is in an uptrend already, and it went crazy, and then boom. And so if it holds this neighborhood and it gets going again, this one could benefit quite a bit. And of course, Lending Tree could be another one that could benefit from it as well. So again, those are a couple of mortgage companies that might benefit very well. And if Lending Tree can get above this 60, 70 area, there's a lot of room for it to go. And then, of course, the home builders. If they're going to build a lot of homes, then maybe these guys, which are in an uptrend on the weekly, maybe they're going to break to the upside. D.H. Horton, or maybe Pulte Homes. The guy is in the government now, Bill Pulte, right? You heard of him? PHM. And he's a little bit more of a high-ender builder, but this is a nice looking chart to go to the upside if they got good news. Toll Brothers, more high-end stuff. And again, these guys are already in uptrend, so if they get a real low mortgage, it could really take off well for them. And then, of course, the last one is KB Homes and Lennar. So you can see that, some of these home builders might be something to keep an eye on as well. And, we'll have to see exactly how things go. All right. Now, if you had any other stocks you want me to take a quick look at, we're coming to the top of the hour, though, and I did want to show you what we're doing here with regards to the alerts. And I'll do one last one here with a firm because that's a stock I've been familiar with for a while. But again, this thing is on the defensive. Yeah, this thing is on the defensive. But it could hold 65, but it's on the defensive right now. Okay, so I wanted to basically show you a little bit about what we're trying to do here with the alerts. Okay, when you come to me on the Option Professor alerts, three things happen. One is you get an options master class. Now, when you hit the word complete purchase, you'll get a receipt sent to you in the email, and you get an immediate class sent to you in the email. It's 3 sessions, 6 hours of comprehensive knowledge education. Okay. Second thing you get is every Sunday night you get a comprehensive review of what's going on in the markets that I just gave you a little brief one. And then secondarily, you get ideas. And some of the ideas that have been on there have been outstanding. Not all of them. Some of them don't work because if you do an option strategy and you don't get volatility, options go down in price. You're supposed to take losses and move on to other ones. That's what risk management and trading is all about. But there have been some very good ones, and here are some of them. These are just in 2026. Can you see they all expired pretty much on January 16th? All of them, except for 2, right? So how does it work? On the alert means on Sunday night, November 23rd, there was an idea about Abercrombie and Fitch with an 80 call, 50 put for 275 bucks. That's the total risk and total cost. Now, you don't have to buy both at the same time, even though it says call and put. You could, if you obviously think it's going up, you can buy the call first and then buy the put if you think you need it. And if you did that, you wouldn't put up 275, you would put up less. But if you want to do them both at the same time, that's fine too. So again, the maximum risk with 275, what did Abercrombie do before January 16th? It ran up to 133. Obviously, 133 minus 80 is $5,300. So that's the maximum intrinsic value, which means your 275 had plenty of time after the idea to make a little bit of money on that, right? But the most you could have ever made was 5,300. Dollar General, 2 of them, right? 2 of them on the 16th and on the 30th. Expired January 16th. 213 bucks. It went up to 155 from 120. That's 3,500 bucks in the money. And as you can see, Alcoa, 3 weeks in a row we hit it, 223, 236, 213. You understand we're looking for options that don't cost that much money that could explode in price. When they do, they're very exciting. And if they don't, your risk is limited to what? Whatever the premium costs. So that's quite a number just in January 16th that came due. In 2025, you've got all of these ones. And, you're being alerted about companies that maybe you're not watching, like Teradyne, Shark Ninja, Rigetti, Baidu, Cloudflare, Roblox, Datadog, Boeing, DigitalOcean, big day just lately, Applied Materials, and then Microchip. These are all companies that you might not be watching, so it's valuable to be alerted to that you should maybe take a look at them. And so Applied Digital, I mean, everyone heard of that by now, but maybe they didn't hear about it earlier in the year when we originally brought them to market. So in the alert. So again, we also have longer term options as well. So there's a lot of information. And again, it also comes with coaching. So you get 3 things. You get a course, you get ideas, and you get my cell number to call me, and we can set up time to go over and explain more about our options one-on-one. So you'll see a link, and if you click on it like this is how it works. You put in your name, email, and everything else, and then you come down and you can click quarterly, and there's $100 discount. So you got $397. You come down here, you see it turns into $297. But what I suggest people do is the annual. So you get a full year of information, a full year of ideas, and 4 hours of coaching. And if you click $997, it goes down to just $897. On a per month basis, that's peanuts. And so basically, after you choose what you're doing, you complete purchase. And once you hit complete purchase, again, you'll get a receipt immediately put into your mailbox and the course. So that's a pretty good deal. And you can start learning today by just, again, clicking the complete purchase and getting started. My email is optionprofessor@gmail.com. If you have any questions for me that I haven't covered, you can clearly just text me, email me. And if you would like to text me, my phone number is 725-254-6423. Shoot me a text and let me know when you're going to be available in front of your computer, and I'll come back to you at that time. All right, we're at the top of the hour. David is wanting to know when I'm going to wrap up, so I'm going to wrap up with you. Again, this is Jim, the Option Professor. I hope you guys take advantage of the options alerts, and you can also bring ideas you get from other companies, and we can go through those ideas and maybe see if they pass the, shall we say, the analysis that we can do together. And maybe you could either enhance the idea or maybe avoid it if it doesn't meet your criteria. Okay, so that's great. I'll talk to you soon. Again, this is Jim, Option Professor. And again, good luck and good trading, and thanks for being here. And if you're listening to this on YouTube, just email me at optionprofessor@gmail.com, and I'll send you the link so you can get started. Have a great day, everybody.